credit scoring 1, 2, 3. There are so many techniques I'm going to be talking about today that I've used over the years. And as the saying goes, as more things change, the more they stay the same, we're back into that bread and butter buyer type home buying period. You've heard me probably say that term before, but we're back to the basics. We don't have 2.5% and 3% rates to carry the day anymore. We have to know how to get financing done. The realtors out there are sharpening their sword on their techniques, their sales, everything from that side, both the mortgages and the real estate side. Experience and professionalism are critical right now. Knowing what to do. Do you have plan A lined up? If plan A doesn't work, what's plan B? Do you have a plan C even if needed on the financing end? So we're going to be going through many of those, which credit plays such a critical role in structuring the transaction. Credit scores can allow entrance into programs. Credit scores can help improve eligibility. Credit scores, as you go up the credit ladder, they can also improve, obviously, with your interest rates. And better rates, better qualifying, allow for an increased sales price. So the circle gets completed all the way around. Now, let's take a quick moment. If you could, has anyone this year had any issues with lender qualifying, whether it was a miscalculation of income, misanalysis of credit score might have just missed? If any of those happen, because we've got a flood of second opinion requests that have come in here over the past 90 days. So I'd love to get some of your feedback for everyone that's on here live as we go through this. And anytime you have a scenario that comes up, please throw it on the chat board, and I'll have break points where you can come back and review in between different sections. As you're doing that, let's give a little background on myself. I entered the mortgage industry, way back in 1998. So this month, actually, it'll be my 25th year anniversary. And then I started Metroplex Mortgage Services in 2001. So we just had our 22-year anniversary last year. So I really speak deep from the heart and from experience on this. And I see some additional people joining today. Thank you so much for everyone who attended. And we have offices located in Tampa as our main office, branch offices in Sebring, Florida, as well as Dallas, Texas. And for those of you who may have out-of-state clients, we're also licensed in Texas, Tennessee, Alabama, as well as our home state of Florida. Now, Jenny threw a comment on there, having a lot of issues with lenders that can't bring it to close, borrowers even well qualified. Yes, we're seeing that as well too. So in the credit market comes heavy government loan expertise. You have to have that in today's market with how the rate markets are, and also squeeze out that buying power for each potential applicant. And through that, we are a USDA and VA approved lender. So what that means is we're doing all that underwriting, all that loan manufacturing right within my office. So we have such control, which allows us that high level of communication everybody's accustomed to, closing on time, and our follow-ups. So through that, we're able to get these tough deals as well as the not so tough deals, whether they're good, average, medium, we maximize the qualifying ability. So additionally, we do work with FHA and conventional loans. We're going into the heavy credit lifting today. I'm also an attorney for the company, and through the Mortgage Banker Association, have the certified mortgage banker status. And most of all, most of you that know me who's on this call, I love what I do, and we have a passion for today's subject. So let's go ahead and get started. All right, here's a slide. I actually added this last night. This is fresh off the presses through the courtesy of the New York Fed Consumer Credit Panel and Equifax. This is a makeup of the debt share by the type of loan. You see at the top here. Can everybody see this okay? You see we have the different categories up here. And then the percentages by age. There's one common factor in all of them. The commonality is, you see here, mortgage is the orange. The heaviest, obviously, in the bracket of 18 to 29, student loan debt is on the high side of the percentage. But if you look at the commonality of what's the biggest debt out there? It's mortgages. There, we got here. So there are cash buyers out there, and by all means, you got them, grab them. But look at the percentage of mortgages are out there by age range. That is a common thread for everybody. Their biggest debt out there and their biggest investment in their life, more often than not, is their mortgage, their home, their purchase. So getting these numbers correct at the outset, laying that foundation for a proper qualification has never been more important than it is right now. So that is why I know who you're working with. Make sure the lenders have done their due diligence, because the mortgages, we are getting such a demand right now for people who want to purchase a home. Yes, there are still inventory issues, but there are buyers out there. So I want you to know that we're not seeing this quote unquote slowdown. The demand is still there. We just would love to have them more. We would love to have more properties available. I'm telling you. Okay, so the FICO scoring system. Many of you have heard this, but credit scores are pulled from 3 national credit bureaus: Equifax, Experian, and TransUnion. And it's very common that there's different scores for each. It's actually very uncommon for the scores to be exactly the same. So you could have a 620, a 714, a 664, or whatnot. And the reason for that is credit data may differ as it gets reported to each bureau. Even credit data may not be reported to some bureau at all. I know, for example, we have a lot of clients that have an account with maybe Badcock. Badcock is a home furnishing store, for those of you who may not know, but it only reports to Equifax. So whatever reports from Badcock, whether it's good or bad, is only going to Equifax as the bureau. That's all they're reporting to. So great paying accounts, you're not going to see that reflection in the score. Likewise, if you have some slow pays or late payments on it, that also is not going to be reflective in the score. So the good news is that low score, we don't have to, from a credit scoring standpoint, we might look at that credit as maybe need an explanation, but it doesn't impact the other 2 bureaus in that example. And for mortgage qualifying, you can see right here, and we're going to get to this as we get to the end. I've got some great case studies. I took some very recent case studies within the past 60 days where we have been deep in the credit weeds, fixing other lenders' mistakes and bringing them to the closing table. And I'm going to show you a step-by-step process of what we went through, where they came from, what mistakes were made, and how we fixed those other lenders' mistakes and got these families to the closing table. So part of that we're going to be looking at, and you'll see when we get to that, is going to be using the middle of 2 scores for qualifying. Likewise, if you have 2 applicants on the credit report, you take the lower qualifying score from the 2. So if you have an 800 and a 620 qualifying score, unfortunately, guidelines and interest rates will be calculated off of the 620 credit score. And here are the factors that go into a credit score, which we're going to really dig into this and show you how we can apply this to fixing someone's, not necessarily fixing, but how we can maximize that building credit potential. So you can see here on this breakdown, the biggest factor goes in your credit score is going to be payment history, late pays, bankruptcies, foreclosures, collections, those type of things, your payment history. A close second is credit utilization. That is going to be how much you use on a credit card compared to the credit limit. So that's a major factor that consumers have the ability to affect the quickest and have that short turnaround time from paying the balance down to seeing their credit score increase. And then you have these 3 that follow: the length of credit history, how long have you had accounts, the mix or the type of credit you have, and then new credit versus established credit. Okay, so those are going to be the factors that you look at. So in this payment history, you can see here, this chart shows how old an account, basically the number of months since that late payment, since the last delinquency. So for example, what this basically shows is the closer you are to having negative payments, the more it's going to impact your score. As you get removed from the negative activity, so let's say you're within 12 months here, you're within 1 to 2 years here, 2 to 3 years there, 3 to 4 years, 4 years, or never late. As that gets removed from that negative activity, that's going to be a positive factor in helping the score improve and heal in some cases. In many cases for these home buyers, I tell you, the hardest thing is the buyer wants to buy. You probably have all heard the story. They want to buy. They need to buy. They need to move out. Their lease is expiring, but the credit is not there. The qualification is just not there yet. They need time. And the hardest thing to do is to have them buy into time, because what they'll normally do is start calling every lender under the sun. They will call everyone until they get that answer that they want, until they think they found the silver bullet. And then, as Jenny mentioned, this person may or may not be qualified, but they can't even get to the closing table. They were never a loan to begin with. We've seen a rash of qualification letters that are simply not worth the paper they're written on. So be really vigilant and have a conversation with the lender. Pick up a phone and give them a call. Ask what they've done on the file. They can share with you so much detail. They don't have to go into the confidentiality portions of it, like social security number, specifics on that. They can talk to you about solid job time, good debt to income ratios. Here's what we've done so far. We've ordered verification of employments. You can have that conversation and get a gauge on where they're at with the file and how much it's gone into the qualification. Because at the end of the day, when you're showing those homes, you want to make sure, A, that person's looking at the right homes, B, it's a good use of your time, and C, it's a qualified borrower that you're investing the resources in to show them these properties. And here's some examples of different types of delinquencies. Common terms you may have heard of, but maybe not sure of. So starting at the top, you see charge-off account. And underwriting guidelines can be different for each one as well, too, whether it's considered a charge-off account, a collection account, or whether it's just late payments on a 30, 60, 90-day period. So I'll read to you for those of you who can't see. I've got my glasses on, so I'm good. A charge-off debt is deemed unlikely to be collected by the creditor because the borrower has become substantially delinquent after a period of time. So we have more flexibility with underwriting guidelines on charge-off accounts, let's say on the government side for like USDA, FHA loans specifically, compared to a collection account. So let's jump down to collection accounts. So creditors will often sell bad debt to collection agencies who then negatively report that to the credit bureaus. So this is when it's went into collection, they're trying to collect on the debt. So there are more rigorous guidelines for open collection accounts, but then you have to look at whether it's medical versus non-medical as well too, which we'll talk about in a minute. And then you have late payments. So for example, this was a late payment on an auto, and it shows down here, you see in a little box right here, we have a I-2 means a 30-day late payment. And over here, this is also 30, 60, or 90-day lates. So this will show the time period is late and how late it was, 30, 60, 90. So when we're going through credit, we're looking at the credit reports. We're looking at charge-off accounts. We're looking for any collections. Some people might have an 800 credit score and none of this is an issue. A lot of them, there's many buyers who are midstream to high level even have some of these popping up. And then you have some that are in that entry level where we're working with them on explanation letters. So there's different categories of buyer. We work with them all. I just had a great call yesterday with husband and wife. They are in their credit score, I think it was 809. So this doesn't apply to them. More or less than that, as Jenny mentioned, these are buyers that are well qualified. And it's a matter of how fast, how quickly can we time it up? What do we need to shorten things up to get them to the closing table and ensure that closing day of certainty? So everybody's going to be different. So we work with the high end, the middle range. We work with everybody we can to try to help these families get into a home within the guidelines and apply our experience to maximize that potential. So now, as I explained, we're looking at medical versus non-medical. These are different classifications from an underwriting standpoint. Remember, a collection is a collection from a credit standpoint. It just doesn't get wiped away because it's medical, but underwriting guidelines are 100% more favorable towards medical versus non-medical. And also looking at how many, if it is non-medical, so for example, looking at this chart here, you can see here clearly this is medical. And down here is this cable. This is be non-medical. When you start to begin to exceed $2,000 in collections, then additional non-medical collections, then additional underwriting parameters kick in too. So we're also separating out medical versus non-medical. And for those non-medical ones, we're adding up how many of those are. We're also looking at those charged off accounts and late payments as well too, as we discussed on the previous screen. So it is literally crazy what goes into this analysis. I love it. This is my life. As exciting as that sounds, this is what I enjoy to do, is to find that nugget, find ability to get a loan done where other lenders said they didn't. And I was just talking to a realtor today and she said, gosh, Sean, I wish realtors knew that you would handle these loans at the beginning and they wouldn't have these problems and have to worry about trying to get them resolved and fixed midstream. That would be nice too. But all right, so let's jump on to the impact of utilization on your credit score. So what this refers to is the relationship of your balances in comparison to your credit limits. So how much you owe versus how much you are allowed to charge up to. So your credit limit versus the balance. So general rule, this is very general, that 30% of credit score calculation is a good general rule. So if your credit limit's 1,000, you want to keep that at 30% of that, or 300. You look at the cumulative amount. So if you have 10,000 in total credit card limits, you want to keep your total credit card limits at $3,000 or less. We have seen significantly lower is better than that. That is a general rule. We have seen improvements even made where you're maximizing the score when the balance is only $10 or $12, for example. So we fine-tune this with our credit software, which I'm going to explain and go through some real case studies here at the end. And here's a great bar chart which shows the risk level, somebody's credit risk in comparison to their level of indebtedness on the credit cards. You can see here, when you're 0 to 19, your risk level is low. As your credit card balances increase, now this could also be line of credit, home equity line of credits, mind you. That's going to be considered a revolving account. As those balances increase and inch closer to their credit limits, you see the risk level also increase as well too. Debbie, how's that? I just took off the screen markup tool, so hopefully that lightens up a little bit. So this does show the risk level of indebtedness, okay? That basically your balances in compared to your credit limit. Huge aspect of what we're going to be talking about towards the end here. And then we'll jump through this where the credit score calculation, how long you've had accounts open for. Sometimes people are credit surfing, it's referred to, where people are jumping from card to card to card just to get that 0% interest rate and then closing out the old ones, opening up the new one. So be careful about that credit surfing where you're jumping from rate to rate for rate to rate. You're trying to have that maturity on the cards, that length of payment history. As you can see here, that length of credit history, as you start from left to right, as you're less than 2 years, obviously that risk is higher. As you go from left to right in the graph up to 120 months, you see your risk levels went down accordingly. So obviously length of time plays a factor into this as well too. And then your mix on your credit score. Right, for our purposes today, this is a factor, but it's on the low end. It's a type of credit you have, whether it's a high rate finance company, credit cards, line of credits, auto, mortgage, student loans. There's open accounts such as American Express. Some of those finance company accounts tend to be viewed as a higher risk as well. And a risk number by trade lines. Remember, the amount of accounts you have can vary. Somebody says, well, Sean, how many credit cards or how many open accounts should I have? And that's very personal because some people do better with managing more than other people do. So you can have low balances, on-time payments. I'm not really worried. You need to have some minimum credit for mortgage qualifying in many cases. We do work with 0 credit scores, which I'm going to talk about here shortly. But this is very personal. So you can see here the risk lower, no credit, that could be looked at more risk versus having established credit is no risk. So many cases though, take this from a debt to income when you're qualifying a buyer, having enough credit for showing your credit reputation, but then not overusing that. So it keeps your monthly payments down. That helps from a qualifying standpoint and allows them to search for a wider range of homes because we're not constricted by those debt to income qualifying ratios, if that makes sense. Then we have new credit, which would be your number of inquiries, the type of inquiries, when those inquiries have been done. And then depending on the credit scoring model, you could be looking at 2 to 4 weeks, 4 to 6 weeks, more or less, depending on the credit scoring model, where mortgages and automobiles, those type of inquiries should be counting as one for the inquiry. And then we're also going to be looking at special circumstances, such as dispute accounts, authorized user accounts, and collection accounts, short sales, bankruptcies, foreclosures. Now, before I move on, I mentioned about having how do inquiries affect your account, your credit. Now, inquiries affect everyone differently. An inquiry is, let's say, a hard inquiry. Someone's going to check your credit. Maybe you went to the car dealership, applying for insurance, applying for a loan, credit card, went to Badcock to buy some furniture, whatever it is, there was a credit inquiry. Credit inquiries affect everyone differently. There is no 2 or 3 point hit if your credit is checked and you have that hard inquiry. Inquiries affect people with stronger credit less, and people with worse credit more. So those average credit, those inquiries can add up and affect them more. And unfortunately, usually it's that person that's searching for the silver bullet I talked about before. They're the one that's running up the inquiries over and over. And I have the 800 credit scores that's worried to death that this one inquiry is going to tank their score. And I explain to them, this is not the issue in life you need to be worried about. Based on what you're telling me, you're in extremely strong position. So those stronger credit profiles, inquiries affect less. The worse credit profiles, or the not as strong, it's going to affect them more. So dispute accounts. So you can see here in the explanation, so dispute accounts, they are actually masked from the credit bureau. So think about putting a wall up in front of the credit bureaus. Someone goes in and disputes their account. They are shielding that from being counted in the credit scoring formula. So there's obviously guidelines for this, because you want to make sure that the score that's being reflected is an accurate representation of their overall credit reputation and credit profile. So disputing accounts will mask that activity from affecting the credit bureau, but there are additional guidelines that we have to follow from an underwriting standpoint, from our qualifications. This is one more layer we have to fill in the blanks and do our analysis when we're putting that qualification together. And all of these things, when you look at it as a whole, these are what we're seeing that lack of knowledge for in today's world. You got to remember, many of these lenders have only been around in working in earnest, let's say for 2016, 17, maybe 18, and they went through most of their careers been at 2.5%, 3.5% rates. They're used to conventional loans, rate and term refinances, and 20% down buyers, which all those are great programs, but right now they're not very prevalent in the market. You have to know how to make loans work from beginning to end so they can get to the closing table successfully. And it all starts with what we're talking about right now: credit, income analysis, those bread and butter, back to the basics type of loan analysis that has to be done on every file. Then you have authorized user accounts. That is where you're accessing, going on to another person's credit. You're not legally liable for that account, but you're getting access to whatever payment history they have, their usage, their length of time they've had that account. It can be a great tool for helping someone start their credit, but also it's a sign you don't want someone with 10 authorized user accounts. You want to make sure they have their own credit profile too, and they're working on establishing their own credit at the same time. So it's just something else you have to be aware of as a lender. Maybe not, let's say, a code red, but something you have to consider in the totality of the loan file. And here are waiting periods. Does everyone in here know when I say what a waiting period is? I'm going to explain it, but if you just say yes or no, if you've heard the term, basically a waiting period, or if you're familiar with the subject. A waiting period is how long you have to wait after an event happens. For example, right here, you have a bankruptcy. Look down here in this section. Thank you, Nikki, for that. This might be a refresh for some. For some that are not familiar with it, this is a great intro. Okay, and for those of you who are familiar with it, these are up to date what the waiting periods are. So on USDA, for bankruptcy, foreclosure, and short sales, there's a 3-year waiting period before you can reapply. But we can get exceptions on these timeframes depending on the circumstances. Okay, so that can be reduced from the 3-year guideline that's published in the handbook. VA has a 2-year waiting period. So after a bankruptcy's occurred, a foreclosure or short sale, VA says we need to wait 2 years before an application, your qualification is, you're requalifying. That can also be reduced based on extenuating circumstances. FHA has 2 years for bankruptcy, 3 years for foreclosure, 3 years for short sale. And you see here under conventional at the far right, the most stringent, 4 years bankruptcy, 7 foreclosure, 4 on short sale. Okay, so that's going USDA, VA, FHA, and conventional. You see minimum down payments I have up here for conventional primary can be 3%, second home 10%, investment property could be 15% down, FHA is 3.5% down, and VA and USD are both no down payment. And we're getting a lot of questions on seller concessions as well. I know this is not a seller concession class, but and I'm going to get everybody a breakdown of this chart after. You're going to get this in your important links email that goes out as well too, along with the replay. So this, you can see here from left to right, USDA will permit 6% of the sales price towards closing cost, FHA as well. Conventional has a break depending on how much you put down and whether it's primary, secondary, or investment property. Really, this would be primary. This could be primary or second. And then this would be the investment property guidelines, because the second homes require at least that 10% down payment. And then VA loans have a unique feature where we can actually pay off veterans' debt with some of the closing costs. So if we need to improve a veteran's debt to income ratios, then we can actually use a seller paid closing cost to pay those off at time of closing. Great tool. I've used that so many times over the year to just maximize a veteran's debt. And in today's market, concessions are still not available everywhere, but we have seen them come on the map a little bit more. So with conventional, just to clarify that, it's 3% if you put less than 10% down, 6% if you put 10% down or more, this is going to be primary and secondary for the 10% down portion, and then 2% cap for investment property. All right, establishing credit. So many of these home buyers, they're not mortgage ready yet. We'll take the time, we'll help them become mortgage ready. And then once they're ready, be able to get you reconnected to them when that time comes. So when someone's trying to establish credit, maybe it's someone on this call that wants to establish credit. The best way to do this is through what's called a secured credit card. And that's going to be offered by banks for consumers looking to establish credit. There's other services out there as well too, but that's one of the traditional methods to go. Remember, the credit limit doesn't matter. It's how you utilize the card. Keeping that at between 10 to 30% of the credit limit, even lower than that, can help to generate a higher score. For example, if you have a $300 secured credit card, keeping that balance between $30 and $90, $1,000 credit limit, $100 to $300. Remember, lower is the better on this, keeping that activity. Generally, when you're establishing that credit, it takes about 4 to 6 months for that to have an impact on the scores. To compare and contrast, if you were to go on as an authorized user, you're getting all that payment history and all that activity built in as soon as that authorized user reflects. But once again, that's not building your own credit. You're jumping on someone else's credit. This would be establishing your own credit. We've also seen an increase in building credit, what's referred to as alternative credit or zero credit financing. If someone's got limited credit, we can work with techniques such as phone, electric, water, cable, car insurance, where 12 months of payment history, we're looking for that to be reported. It must be in the consumer's name, the home buyer's name itself, no late payments. We can also look at verification of rent, canceled checks, apartment complexes, management companies. It's really important if you're doing any property management, encourage the buyers to avoid paying in cash. That still happens in a lot of our rural areas that we're in. So if you can all the time pay by check, cashier check, those are a good gold standard type of verification for that. Here's an example. It looks like when we have no credit score at all. So you'll see a 9003, insufficient credit, 9003. That just means no available credit, insufficient credit to report to reflect a credit score at the bureau level. So we're seeing a spike in these. And here's what it happens. So let's say someone has no credit. Actually says, how about if they use Zelle to pay the rent? That's a great way to verify it. We can verify the Zelle payment history too. That's one of the acceptable forms we use also. And obviously, if it's paid to a management company, we get a verification of rent from the management company, which serves to verify that rental history. It's when we start to have the private landlords when we need to open up that method and form of payment history with more of an intensive review of that. So with let's say we need to establish somebody's credit. We're working with someone right now who has multiple people right now, actually, who have limited credit. The credit history is just not established yet. It could be a 0 score. Maybe they have just haven't have the credit established enough where we've got enough scores to. So we're looking at building credit. So real quick, throw in the chat board. I want to get everybody's response on this. Who has heard the terms building credit, maybe non-traditional credit, or alternative credit? Those are all three going to mean the same thing, but who's heard those terms, or who maybe has experience working with these type of home buyers who have had these? Because you got to remember, our days in my office are like rapid fire. What I mean by that is we're getting second homes, jumbo loans, jumbo VA loans, USDA loans, USDA home repairs, single wide manufactured homes, VA loans, double wide manufactured homes, down payment assistance questions, investment properties, condominiums. We are getting, it is rapid fire because they know our experience and know we work with all of these. So we've got to jump from topic to topic, program to program, guideline to guideline. In each one of those, these huge voluminous handbooks that we have different credit parameters. And many times we have to build credit as part of the qualifying. I mean, I love this time of market because you have to know what you're doing to get these buyers to the finish line. I absolutely love it right now because this is what we do each and every day is put the puzzle together to put on the roadmap to get them to the closing table. And this is what it looks like when you build credit. If you can tell my excitement, this is so true. This is how loans are made. So building credit, this is one of the options we can work with. So person sends in their documents. You've got we can coordinate a three-way call with our credit company, the home buyer, and the vendor. So in this case, we have internet, cable right here. We had energy right there, utility, and we have cell phone utility right there. This shows that we've had overnight. When it's 99, doesn't go higher than that. So that's at least 12 payments, okay? We have no late payments for 30, 60, 90 days. Here's their minimum payments. And this is the format that our credit company gives back to us so we can use from an underwriting and an eligibility standpoint. So this is referred to as a credit supplement. This is not establishing credit at the credit bureau levels. This is giving us that non-traditional credit. This is what building credit means. So we're establishing that credit. Now, this isn't for everybody, okay? This is not for all buyers. Like I said, for that 809 credit score buyer I spoke to yesterday, putting down 40%, this is not for them. That's a different call, different program analysis. This is going to be for that maybe that first-time home buyer looking to get government loan qualified, USDA, VA, FHA potentially, and they got great job time. They just have not. They're off the credit grid. They're off the credit radar. And here would be an example of verification of rent would look like when we get one filled out. Here's what we're looking for on the left-hand side: your rental account, date they've rented, how long they're current, a monthly amount. Is there any arrearages? No. You see here, no. No late payments, satisfactory account. Boom. That's what we're looking for. Now, credit qualifying. Let's jump into we use an underwriting system. This is specific to USDA loans. We obviously work with USDA, VA, FHA, conventional. Realtors refer to us for our specific USDA and VA expertise because these are the hardest of the hard in many aspects. Guidelines are complex. Qualifying ability of those equally flexible. So knowing how to maximize these programs can really open the door for our rural home buyers, our veterans alike. Really, USDA and VA side by side are two great tools to have in your arsenal. So we work with, in the USDA program, we work with a specific underwriting system called the guaranteed underwriting system. Because of our approved lender authority, we do all of this underwriting right within my office. This allows us to close our USDA loans in 30 days. We got contracts on Monday that with a closing date of June 30th. So we're cranking away on those as we speak in the office. So there's different levels of classification, which I'm going to leave this for our USDA class that we're going to have coming up, that upcoming workshop. But depending on the type of credit profile, that may require what's called manual underwriting. Has anyone heard that term manual underwriting before? You may have heard me talk about it in prior classes, but has anyone heard about manual underwriting versus automated underwriting? If you haven't, here's something to ask lenders you may be working with. Ask them, do you work with manual underwriting? Because here's something that comes up that might be able to help save you a deal, whether we end up doing the closing or not. You want to, if the lender tells you USDA, I'll use USDA as a example because this is what comes up the most. Someone will say USDA requires a 640 credit score. USDA requires a 620 credit score. Not true. USDA does not state a credit score minimum. They defer that to the lenders to establish one. For example, our current minimum score right now is 580. You have to have the credit, not just the score. Both those have to be married together. But that's going to more or less require manual underwriting, which is a more intensive review of the process. So manual underwriting, you'll have to ask them, do you offer manual underwriting or only offer automated approvals? That's the key lingo that you want to have. Automated versus manual. And then you ask your lenders, if they don't work with manual, you're missing a big boat. These buyers can be so well qualified. It's just more experience and more understanding of how to maximize the guidelines from the lender standpoint. So that's a critical question to be asking your lenders. If you take anything away from today, be in the know of what your lender's capabilities are or what their minuses may be as well. So is everybody clear on that? Manual versus automated. Two different ways. Think of it this way. You could be going down a dirt road or a freeway. One may get you there faster with less bumps, but they may both get you to the end destination. So it's just two great ways to approve a loan. Not all lenders work with the manual aspect. We work with both. And here's an example of the underwriting screenshot that we would have from the GUS underwriting system. So you see this would be an example of an accept, which would be an automated approval, which can give you less documentation. No need to verify rent, no credit explanations, those type of things. We really break these down in our USDA class step by step as well too, the difference. Here you'll see up at the top a refer. So you see a refer up there. Refer is going to mean it's referred back to an underwriter for manual underwriting, and a more intensive review of the file gets applied as well too. Now, I say the last 15 minutes or so for credit rescoring. This is something that can really turn the needle and make a difference with your closings. And Laura, you're so welcome for that info. I mean, that's a critical question to ask, and many lenders may not even know what it is. If they don't know what it is, then that's a huge red flag. So credit rescoring, also known as an expedited request or accelerated rescoring. All those mean the same thing. What that means is first of all, this is not credit repair. We're not a credit repair company. We're targeting specific accounts with that home buyer's credit profile that can help maximize their already existing built-in potential. This is something that can turn a buyer from someone who's denied to eligible in less than a week. And I'm going to show you pinpoint example on that here in a few minutes. So the big picture is we analyze the credit. I pay for extensive credit software that ties into our credit bureaus, our credit reports. And that allows us to go in there and run simulation. Every time we run this, it costs money. So there is cost that's not passed on to the consumer. That's why a lot of lenders have pulled back from this approach, because the cost can go up. I have worked with this credit rescoring in various forms from going back to 2003, 2004. Everything we do now is on steroids compared to back then because of the technology. I have so many tools at our resources. Think of it this way. You can get two people and get two pizzas. One could be plain. They're both pizzas. So in this case, we got two credit reports, two different lenders. One has just the bland credit report. It says, here's your scores, here's the accounts, here's your late payments, collection, etc. The other lender pays for deluxe pizza. So we have a deluxe pizza and then some in my office. We pay for all the bells and whistles, the ability to look at soft simulation. What happens if you pay that account down? What if they got that collection deleted? What if that account was brought current, et cetera, et cetera? We can go through. What if they got removed from an authorized user account? As we go through the checklist, will show then, here's what the new prospective credit score will be after these actions are done. So we're targeting, you can see right here, specific accounts to be paid down, paid off, or even brought current. Once the action is done, then we get that information, we get the documentation from the buyer, and then I pay for that expedited request, that accelerated rescore, to our credit company, who then talks directly with the credit bureaus to update that real time. We're not waiting 30, 60, 90 days for them to get their statement in the mail and for that to then reflect to the credit bureaus. We're doing this instead. We're shortening that in 3 to 5 business days, so less than a calendar week. And once an update has been completed, then we get notification. Then we're able to go ahead and update and process a new credit report with the new credit scores reflecting. So before I go on, does everyone understand the big picture of what we're talking about here? This is credit rescoring, also known as rapid rescoring, also referred to as an accelerated rescore. Because you see why the terminology is rapid, because we're not waiting, we're expediting this to the front of the line. We're moving the credit review process up. So give me some feedback on the chat board, everyone. I want to make sure you're in line with the concept here. Thank you, Debbie. Appreciate that. Vanessa, thank you. Exa, you're right. This is an amazing tool. You're going to see this. Let's jump into it. All right. So the first step is we're going to take a look at the credit report manually to go through all those things. We're going to look at those collections, charge-offs, all those things we talked about at the beginning of the workshop is coming back right here. We look at all of those details. We manually go through the credit report. Some of these credit reports are 10, 15, 20 pages long. We're analyzing each account. As we look at this, and at the beginning of our credit report, I pay for an extra resource. Okay, this is on top of that rescoring. This could tell me potential improvement. Okay, you see here. Here is the potential improvement we can get with Equifax. We can get with TransUnion. We can get with Experian. Here's all our potentials, how they could go. Okay, but this doesn't tell me what actions to take. This could maybe the buyer only has $500 to work with. We got to work with that budget. And to get 48 points, it might take $2,500. So this says there is room for improvement, but it doesn't give me that granular details that we need to show how we can maximize their score and do it in that short window. But at the same time, we got to stay within their budget because they got to buy a house too. Remember that. Okay, so this is one of the tools we have that gives us a roadmap of what kind of potential increases we may see. And here's another example of how that looks as well too. This will give us that quick at a glance where it shows you the potential score. So there's Equifax that could go from 684 to 752. Now, remember, we also work on the mortgage side, we work in credit brackets. What I mean by that is your credit score, 600 to 619 is one bracket, 620 to 639 is another, 580 to 599 is one, 640 to 659 is another. And as you cross into each bracket, that can help with your score or additional guideline eligibility improvements, or better, what it means to you is it can help improve the sales price range they can look at. It can help look at the available properties. So this tool is not only to help home buyers become mortgage ready, but also to help them get up the credit scoring ladder to help with their rate, which lowers their payment and helps with the home price. Okay, so we have here, you see 684 to 752, 702 to 782, 740 to 769. This is amazing. Guys, this is amazing under the hood the details to show what I'm looking at on a day-to-day basis. So this person right here, 638 to 646. Okay, so if I'm looking at this, let's say we're getting qualified for USDA VA. I'm not worried about this applicant at the top. what can we do to get this buyer who right now they're in that 620 to 639, 640 to 659, and 620 to 639 range. Let me ask you this. We talked about this earlier. This is obviously not a CE class. This is not a test. But let me ask, on this buyer right here, of these three scores, 638, 649, and 633, which is the score we'd be using for mortgage qualifying? We talked about this at the beginning. Now I want to make sure you lasered in on that. So of these three scores, if you don't know, you got a 33% chance. And I want everyone to take a stab at this. Which of these scores, 638, 649, or 633, is the mortgage qualifying? X says the middle, but which one do you say is the middle? And I'll tell you why I asked that, X. So which one? So we got 638, we got 633. All right, this is good feedback, everyone. All right, I'm so glad we did this, okay? Let's go through why it is what it is, okay? And what you want to make sure is it's not the middle score as it appears on the page, okay? This is really important because when you say middle, that can mean two different things. It could be the middle statistically wise, or it could be the middle where it's actually located. And this is important. So in case you ever see a credit report, you know how to reference this, okay? Let me clear the whiteboard. So I'm not worried about the top buyer because more or less they're already in a good range for us to work with. We've got a middle, even despite these credit scores though, we're going by the lower middle. So the answer to the question was 638. Remember, this is the middle on the page, but this is the middle numerical one. And that's what it goes by, okay? And so 638 is this applicant's, these are their three scores, okay? So 638 is the middle score for them. Their middle score is 702. But because we have two applicants, we default to this one for interest rate calculation and qualifying. Is everybody clear on that? I kind of wanted to spend just a minute on this before we get into the last couple of slides. If anyone needs me to talk afterwards, I can stay on. I know many of us have time constraints, but I will spend more time on this afterwards. But I want to show you. So now we're trying to get this person up to the next credit bracket because that helps them both in their qualifying. Could you give me a yay or nay if we're good to move on? I will take that as a yes. We're good to move on. Okay, thank you, Reggie. Thank you, everyone. Yays have it. Okay, let's keep moving on. And if I need to stay afterwards, I'll answer questions post workshop. No worries. So here's just another credit expert essential. This is more tools we have at our. So then now we're at the point where we've suggested actions. We tell the buyer, you need to do this, this, and this. They'll pay down a credit card. They'll get removed from something, bring an account current, whatever it is. They call their credit company, and then they get us the documentation. That's when I pay for that expedited request. But remember, all these simulations, all these scenarios we ran, I'm paying for that too. And we are absorbing that cost because I know the end result is an investment in the process. So I'm okay with that. But that's where a lot of companies right now have pulled back from this because the loan officers and the branches do not want to incur this cost. Instead, they'll just tell them to wait a couple months and we'll follow up with you and pay down some accounts. That's not a plan. If you fail to plan, you plan to fail. Everybody knows the saying, and this is exactly what it is. So now we submit the documentation, like I said about, and then we're waiting 3 to 5 days to get that notification, sometime sooner. And here's an example of a before that we work with, where in this case we had a 612 credit score was the middle. Remember, 599s are low, 640s are high. This is our middle. And then our new middle score went from a 612 to a 690 in this example. Now let's show exactly what goes into this in a real life scenario. This was real life as well too, and this home buyer purchased a home as well. Before we get to that, let's talk about deleting. We can actually look at helping home buyers if they want to pay and settle an account and the creditor is willing to delete that. They can actually negotiate a deletion letter and get that to us. And then we can use the same credit scoring process to get accounts deleted as if it never happened. And that also helps improve their credit. They're cleaning up credit on their own. This is not a credit repair that we're doing. The buyer's doing this on their own. We're helping to give them a roadmap and give them the inside details on what they need to do to help their own credit profile. Here's another example of our software that we look at. This is referred to as a what if simulator right here, where we were able to say, if you delete this account, pay this one down to $1,547, your score goes from 638 to 732. This is game changer information, game changer from a qualifying standpoint. This helps in our market right now where rates have risen and stabilized, but it helps anytime we can help reduce the rate, reduce that borrowing cost, it helps their buying potential and that availability you can look for. All right, let's go through. We have 2 case studies here, so we're going to burn through these. All right, these are real life ones that just happened. So let's start. This is a credit inquiry sheet. All names redacted, all buyer names, personal information. These are just the inquiries from the party who inquired on their credit. Okay, so you see, let's start. Here's where they began their search in earnest, let's say at the end of November. Down here. So November 30th, there's a mortgage inquiry there. You see as they went up, there's one on January 11th. That's the same one. This one right here is on January 20th. It just reported differently. So that's the January 20th. This one is the January 11th. Now we had the same January 11th creditor come back. And they reran their credit again this time. So it was basically within 9 days. They just reran their credit arbitrarily. Then this lender reran their credit again on March 15th. Okay. Then we got the referral on March 21st. And here's the timeline here. So you can see here at the beginning. Now I'm going to walk through the steps here. But here's what happened on March 21st. We got in touch with the buyer. We did credit rescoring. And on March 27th, 6 days later, we put together a specific plan. And we went from, you can see here, 572 middle score at the top to a 601 qualifying score. That was less than a calendar week. And here's how we did it. So March 15th, they were denied by their lender broker due to distance requirements needed for the well. So this is the final, that March 15th was the final gasp by that broker to hopefully their score was higher. I used the word hopefully because that was the game plan, hoping the score was higher so they could switch to a conventional loan. Loan got denied. We were able to speak with the buyer first on March 21st. And due to the various lenders just arbitrarily and randomly running their credit, the score had plummeted to a 572. We went through this whole credit. We put all our resources to work on this. We did the credit analysis. We did everything. We put together the credit game plan. Buyers jumped on board immediately. We received their documentation back. Now we're at March 23rd. And we submitted the paperwork then on that Thursday, the 23rd. We got that back on Monday, the notification. So we took them from a 612 to a 601 in less than a week. We got them qualified for a USDA loan. We also coordinated with local SHIP program, State Housing Initiative Partnership Program. We also work with them locally on that program, which saved them thousands of dollars because they were trying to go FHA before with no down payment assistance. We got them down payment assistance, loans approved, we got appraisal back. We gave the green light to the builder. Builder moved the well, so we didn't have any distance issues. We got the property survey updated to reflect the new distance. Loan closed, happy client, happy builder, happy realtor from our start to finish, 35 days. And that's how you put together a specific plan. Now let's jump on to the next one. And yes, I had some questions along the way. I'm going to go over some credit scoring brackets. I can wrap that up after class in case people have to go as well. Great questions, though. All right, this is our second case study. Okay, you see we did three on this. This one had extensive. So once again, thank you, Vanessa. I thought this is intense because this is what's happening to make these deals work. And there's so many deals getting lost. Okay. There's so many deals getting lost in the shuffle. So I know we're at the top of the hour, but I'll get through this quick. If anyone has to go, you're going to get the replay. I respect your time as well. And I want to thank you for anyone who does have to go. Really appreciate taking the time today, but I'm going to go through this. I'm going to show, really tie together what we spoke about so far as well here. So in this case, once again, the screenshot is the credit inquiry timeline. This really helps paint a picture of the timeline and what lenders have done. So they, in earnest, started looking for financing here on March 17th. Okay, that was really right here where their first inquiry was. And this was that first inquiry right here. And then the buyer had told us that they were given advice to wait 2 months, pay off some accounts, and they're going to get followed up with a couple months because their scores were below 620. Now, remember, as I said before, USDA does not set the minimum credit scores. Okay, this is lender specific. So on this one, this just happened. This was just last month. So in this scenario, you see at the top here, April 4th. At that point, the borrower's middle credit score is 619. So we were able to move forward because they met the minimum credit. They had the credit background. They had the credit reputation. Okay, so we were able to move forward while at the same time, we proceeded with the qualification immediately, but at the same time gave them a credit roadmap to show them if you, by paying down debt, because this time we were looking for how we could improve their qualifying budget by paying down debt. So in this case, because the ultimate goal is obviously you see they increase their buying power while they're looking for homes. So we're saying we can start now, but get out there and look for homes. And here's what to do along the way. So April 22nd, they went under contract and we started the application. The buyer during midstream, this is one of those real life situations that comes up. Unforeseeable, no one's expecting it, but they received a reduction in pay, which increased or worsened our debt to income ratios. But because we had implemented that prior game plan, they had already paid off some accounts. But when we updated the credit, they had lower scores due to various factors on their credit. So we jumped into credit rescoring again. Now we're on May 15th. We're in application, in progress at this time, trying to get a solution to this in progress event that happened. How can we fix it? We went back through and looked at the credit rescoring again. And we found that the credit report had not reflected a proper balance update with all where the game plan we had put down. So I paid for another credit update, another credit rescore, where we submitted for that accelerated rescore again. So then after they got us the paperwork, we got everything submitted. Now we're looking at May 25th. So the credit got updated and we had new increased credit scores. So this is a great illustration of how we took a potential negative. First of all, we got them out looking for homes when they were told by others to just sit on the sideline and pay down some accounts. And here's where we start at the top. You see April 4th, middle credit score is 619. April 15th, you're looking at, it dropped to 566. Okay. And then we took that back up to a 610. So they had the credit behind it. It wasn't just a score, but we needed that minimum credit score. Also, it helped with from an interest rate, getting them up as high as we could. We had the loan closed on the 31st. Another happy client, another realtor. That client has already referred us their family to help them become mortgage ready as well. So really local success stories that are knocking it out of the park. And this is preparation. This is when you have a true plan, not just shooting in the wind. I can't say it enough. So a couple of helpful reminders: no additional charge for the service. Remember, we're not credit repair. Timing will depend on how quickly the buyer pays down credit. Results are not guaranteed, and this could be ideal for paying down credit card balances, but not limited to that. Now, remember, when I said this is not credit repair, this is not going to be for the buyers that their credit is in such disrepair. This is going to be for those buyers. As you can see, these credit scores were in that striking range. So this is not a silver bullet for everyone. This is a tool we can use based on the buyer's profile that may be able to help them climb the credit ladder. Now, it can be great for both those upfront qualifications, or if you have those transactions that Either A, they're fumbling around with the credit, which we've seen so much, or B, they're just got outright denied because of credit score or some other maybe special circumstance that we talked about earlier in the workshop. And we always get this question, Sean, what is the best way to recommend a buyer? The best way is to get permission for us to reach them. Call, text, or email with their contact information. And I'm going to throw this in the chat board as well too right now. Call, text, or email with their contact information. Get permission for us to call them. And our dedicated team in the office, we begin to follow up. And then we can keep you in the loop. If we don't know who they are and they're supposed to call us, then we have no idea how we're supposed to call in, and neither do you. Because our big things are closing on time, communicating, and following up, and getting our solutions and providing solutions to the closing table. And Charlotte, I can put that on there in a minute. Give me a moment. I'll get that contact information for you. And then creating a successful referral, we talked about that. Getting the proper qualification, okay? Getting that proper qualification is that next step, building that foundation. Then getting out there to buying a home. Getting them under contract, getting them into loan application. This is what we refer to as the homeowner assembly line. Walking them through the process step by step. And as we continue on, getting that appraisal order as soon as possible. We have loan applications coming in today where we're ordering the appraisal the same day. There's some lenders out there that are waiting a week, 10 days, 14 days. I just heard a story over the weekend where they waited till 10 days before closing to even order the appraisal. Going to loan processing and underwriting, where we've done all that upfront work, just carries down the road and getting to closing, obviously. So if we need more questions, you guys are going to get important links. Please, by all means, let us know. I want to thank everyone who attended. You are so welcome. And I want to thank you all for the feedback. So I want to wish everyone a great day. Looking forward to working with you on your next deal. And please let us know in the meantime, any questions, comments, anything we can help with, second opinion request. We're here as a resource to go to work for you. Have a great rest of the day, and we'll talk to you soon.